And it's 9 o'clock. My name's Sterling Smith, and I'd like to welcome you to the October ASNA Edge marketing meeting. Before we get started, we have a few people joining, so we'll go over a few housekeeping things. One thing that I'd like to remind everyone, make sure you are getting the podcasts. I put out three a day, one in the morning about 10 o'clock Central Time, along with the livestock one, and I put out one in the afternoon. I don't need to tell everyone how volatile and how different of a time things have become over the last couple of weeks, but we are seeing markets that are behaving differently, and we have a lot of different outside drivers that were not in place before. So with that being said, let's go ahead and get started here. I'm going to go ahead and share my screen. And for those of you who have been on a few of our calls, such as the WASD and things of that sort, the news of late, particularly in the grain market, hasn't been anything that's particularly good. But today I have a little bit of better news. It's not great news, but it's a little bit better. And let's start by talking about the December corn market. As you can see on my chart here, prices have been doing better, and we are rallying a little bit today. What is driving this is not necessarily anything that's overtly bullish for the corn market. As we saw with the last WASD, they did cut ending stocks a little bit. That came via production cut, but along with it, they also cut exports. So we're watching those again very closely, because even though they cut ending stocks, the number we're at is still burdensome and can weigh on prices. But as you can see here, we have managed a little bit of a rally, and we're getting a little bit better technical picture as we've broken above some of these near-term moving averages, and the oscillators are not yet overbought, so that is driving prices up. What is actually predicating this and what is pushing this is, I'm going to switch to a chart here, and this is a chart of the net fund position. Speculators come into the market and they assume positions predicated entirely on whether or not they can make money. So when hedge funds are in here buying corn, that naturally works as a natural lift to prices. When they sell corn, that naturally works as a weight. Now, if we look right here at the most recent action, we had seen a fairly substantial large net short, and we have seen that covered. In the last COT report, they had covered about 20% of this. And this is working to help lift prices, and what's creating what we're seeing in that chart action. What's driving this is not necessarily anything bullish for the global corn market so much as it is risk aversion, meaning the situation in the Middle East, the situation with interest rates is driving this market. Now, what I think we can see over the near term, the big question really, as you can see, every time we got up next to $5, we found selling pressure. At 4.95 and 3/4, we're getting precariously close to that, and we're going to get our answer about whether or not we can get above 5. If we can get above 5, that should give us a chance to probably find prices. Maybe we can get as high as 5.25. I think that's a reasonable expectation. I don't see a lot of things here to really drive the market higher. While the funds were covering 20% of their short position, simultaneously we saw hedge pressure coming in. And what happens in the futures market? When farmers deliver their grain to elevators, elevators sell a futures contract, and that offset. But right now, proclivity for the fund buying is working to support the corn market. So the picture has gotten a little bit better, but my caution and warning on this is not well predicated. And if we stall out at $5, I don't think the funds are going to be willing to be as aggressive a seller, but they may very well turn back into sellers and try and make a little bit money on the short side. So that is the key area to watch there. The other thing that has been helping us, and if you've been on our other calls, Brooks and I have expounded on this ad nauseum, is we are getting a little help from our friends in the soybean market. The WASD on the soybeans left ending stocks unchanged. Production got cut, but again, my caution and warning on this, we also saw exports get cut, which offset what would have otherwise tightened the balance sheet. With the 220 carryout, we are not burdensome, but we are not exactly screamingly bullish. We have some things going on in Brazil. There are some planting delays in some parts of the country due to excessive moisture, and that is keeping soybean planting a little bit under pressure, but we are seeing corn planting moving along for their summer corn crop at an extremely good pace, and this can change. Along with this, Argentina has had some issues with dryness. Those are expected to abate over the next couple weeks. I'm going to extend an early invitation for our November meeting as the Planalytics weather people will be on with us, and we're going to discuss specifically what the outlook is for the key growing period across South America, which is going to be a big driver for the bean market. Now, looking at the chart here, as you can see, we've seen a bullish cross of the moving averages here, which is supportive. Now, today's price action is a little bit troubling. When you listen to the podcast, I always talk about where we've traded relative to the high or low of the day when it's significant and important. And this is something that if we reach a peak during a day and we do not, can't see that sustained, that can very often invoke some algorithmic and some computer-driven selling. And I'd really like to see us finish positive today as the stochastics, while we're getting close to an overbought situation, and so are the RSI, we still have some room to work. And if we can manage to stay above $13 for a protracted basis, let's say a week and a half or 2 weeks, the market may get a little bit more comfortable. Now, the fund position in the soybeans, they had a net short, and that most likely, I haven't gotten the data yet, we won't get that until tomorrow. I saw open interest expand, which means there was buying in the market as the market was rising. Most likely the funds have covered this net short, and along with this have come in and bought, some fresh longs, which again is supportive if the market is expanding. What we don't want to see are prices going up and open interest going down. That just means shorts are exiting the market, and that can create some pressure. Moving on to the wheat market. The wheat market has been difficult at best. Every time we get a rally, we seem to see selling pressure come in. The funds in the wheat market have a very substantial short position, and I'm going to go ahead and put that up here very quickly for us. Here, if we take a look at the net short in Chicago, you can see it's a net short of about 94,000 contracts, which, if you'll see this, the red line is the current position. This is a noticeably large short. Now, this short has been accumulated for a while. The funds have been incredibly stubborn with this position, meaning when we saw the invasion in Ukraine, the funds had not done much to cover this. Now, we are reaching a point to where I'm not saying we've absolutely put in a bottom, but in terms of fund activity, if you're a fund manager, you are probably under some pressure to reduce risk. You have a profitable position, you're going to be inclined to take it off. And I think we are beginning to see the inklings of that. This recent rally in the wheat did show, healthy behavior in open interest, and that open interest expanded, meaning we're seeing shorts covering, and we're also seeing some new fresh longs come in. So looking at the wheat market, $6 here again is that magic round number for wheat. If we can get wheat above $6, we can accelerate this. As along with that big short in Chicago, the funds have enormous short positions in Kansas City, which is a smaller market. And more importantly, they actually have a very large short position in Minneapolis, which, having spent some time up at CHS in Minneapolis, we know this market is very compact. And if we see markets begin to move up, we see covering in there in that quality wheat, that in turn, that tide can, maybe spark a little bit of a buying frenzy a little bit and get prices moved back up, at least for the time being. Global demand for all of this is very, very much hand to mouth. And when you look at the export reports that I put out, we talk about export sales, which what happens is somebody comes in, the United Kingdom or China comes in and buys a commodity. What I'm seeing is they buy wheat on Tuesday, it gets exported to them on Wednesday. Right now, there isn't enough risk premium in any of these markets. There's not a lot of supply concern. Demand is sloppy at best, with the exception of soybeans. So they are very much hand to mouth in their buying. That means they're comfortable, and hopefully we can get them to a point to where they get a little too comfortable, and maybe we can start seeing them buying forward and getting a little better coverage going forward, because the key for corn and soybeans to get a rally is seeing better exports. We do not need to see the USDA cutting that, because that just means more supply coming into the US. Now, we need to temper this with the situation with the Mississippi River and the drought that is occurring in the southeast United States. River levels are low, and this can interfere with movement of grain down the river, and also that can create basis problems for producers. So that's something this will change. We're right in prime time for river season moving soybeans. We've seen good inspections, but that's going to come to an end when things freeze up here the first or second week, third week in December, whenever that happens. So those are the things that are going to be challenging the market from the market internal situation. We're still dealing with heavy stocks and a situation that, from a fundamental point of view, is heavy on prices, but we are seeing some things that can at least work to lift prices. Now, we need to talk about the global macro situation. The first thing I'm going to talk about here is crude oil. This is a chart of December crude futures, and as you can see, for most of the year we trended higher and we challenged the $90 level. And let's get into what happened over the last 2 weeks. Right here you can see a sharp break in crude oil. There was a DOE report that showed gasoline consumption falling off a cliff. It had dropped down to the lowest level since 1996. The subsequent reports, and if you want to see all of this data, this is always included in the Wednesday report, including any big outlying ideas and things that are driving all of the markets. Because to look and understand the grain markets, you need to look and understand everything that's going on. We have since recovered that. Here is when the terrorist attack in Israel occurred, and we popped higher. So far, we have ground higher. The reason crude oil did not move sharply higher is, one, where the violence occurred. Most of the crude oil is actually produced in the eastern portion of the Middle East, Saudi Arabia, Kuwait, and that area. Israel and Gaza are on the western side, so thus far, and I want you to remember yet and thus far, those are the two most important words about everything I'm talking about, because we are dealing with a very fluid situation. Thus far, we have not seen anything to affect crude oil production. We have not seen anything equally important to affect crude oil shipping. Now, this situation in the Middle East is not an incident. This, again, is most likely going to be a longer slog, much like what we saw with Ukraine, where we saw the immediate impacts, and then we saw things down the road. So far, the immediate impacts have been rather muted. However, if we see this spread into a wider conflict, meaning we involve the Iranians, something like that, or if there's an attack somewhere within the oil producing area, this market will change in a hurry. So this is something that has impacts, obviously, diesel and everything. We should be priced, but moving forward, this is going to have a broader economic effect. Now, our exports are priced in dollars, and this is a chart of the US dollar. When the dollar strengthens, that creates a natural headwind for exports. And as you can see, the dollar has generally moved higher, and we have stalled out the rally a little bit, which is a little unusual, because the main drivers of any currency are going to be, one, interest rates, and two, risk assessment. Normally, when we see a risk heightening situation, for example, the problems in the Middle East, we see more money flow into the dollar. This has not happened this time around, and that's a little bit different from the same playbook that I used during going back to 2001, 2008, and other situations like this. What we have seen instead is money flowing into the Swiss franc. We've seen money flowing into the Japanese yen. We have seen money flowing into gold. So we are seeing a diversification of risk, which is a fundamental change in the playbook. Now, looking at interest rates, this is a chart of the 10-year note, and the US government issues debt across everything from overnight all the way out to 30 years. And that's referred to as a yield curve. And right now, The most money you can make with guaranteed certainty is overnight money and 3-month T-bills that are yielding about 5.35 to 5.5%. The 10-year right now is yielding 4.93%. That's not normal. Normally, the longer out you lend money, the higher the interest rate. That is how the yield curve normally works. Right now, it is inverted, meaning you get more money being an overnight money than you do extending out 10 years. The natural physics of finance is that this yield curve will eventually work and revert, meaning we will see 10 years trading above overnight rates. This will happen one of two ways. Either one, the Federal Reserve starts cutting interest rates but with where inflation is right now, that is probably a low order of probability. The more likely scenario is assuming he sticks to his tune, rates higher for longer. This will be a natural process and will probably push these rates somewhere at least north of 550 and probably push 30-year rates closer to 6. What this means for the grain markets and what this means for the economy in general is, one, borrowing money has got a lot more expensive. Two, this affects how you appraise risk. When interest rates are sitting at zero, large amounts of money from hedge funds, big investors have to take risk because you can't sit at zero. So that increases volatility in the commodity markets. When we see interest rates rise, well, I can trade corn futures and maybe I'm going to get this sort of return, or I can take 5.5% and take it into the bank. That has a muted effect on volatility. Now, for the time being, that is good news for the corn market, meaning most likely you're not going to see a lot of aggressive selling. That also means people are being a little bit more cautious about appraising risk going into, things like crude oil. So that has tamed the response. That's somewhat the good news. The bad news with this is we're getting to levels where something is going to break. We have not seen these levels of interest rates since 2007. And we don't want to get into what happened in 2008, but things started breaking. What is going to happen is credit is not only going to be more expensive, very, very soon. We have not seen these effects yet, but this move up in the yield curve is going to cause a tightening of credit. Credit is going to get harder to get, and it's going to be more expensive to get. This affects company expansions, farmer operating lines. It affects the consumer in that all of a sudden, not only is it harder to get a car loan, it's going to be more expensive. In fact, in 2008, before things really started to really explode and making headlines, it got to the point where people with perfect credit scores could not get car loans. I don't think we're going to see that this time around. The banking system is a lot more healthy, but this is going to have a grinding effect on American business. It is going to have a grinding effect on the economy. And this great debate about whether or not we're going to have a recession is very mixed because we see things like weekly jobless claims, things of that sort, have continued to improve, meaning everyone's working and everyone has money. As long as we have that, we can stave off or keep a recession under control. But everything from the cost of money to pockets of inflation are going to be very, very hard to tame. And for example, a 30-year mortgage is now 8%. 3 years ago, when I bought this house, our little bit of a mortgage that we had on it was at 2.65%. So this has changed the paradigm. These things are very slow to move through the economy, and that is why we have not seen things shake so far. I'm going to look at one more item here very quickly. We're going to talk about the stock market a little bit, simply because if we start to have panic, when this thing starts to move uncontrollably, the biggest market in the world is the US debt market. The second biggest market is the stock market. As you can see, we have had a struggle. One little technical thing that I'd like to point out for anybody who follows charts, if you see this day right here, where the market makes a new high for the move, falls back and has a wider range and finishes the day lower. They say markets don't ring bells at tops and bottoms. There's a lot of people at the Board of Trade who would dispute that argument because pretty clearly we saw a bell ring here. We see something like that, particularly in the soybeans with their recent rally, that may be a sign that the market is about to turn. One thing I'd like to point out, this is right here is a key level just above 4,200. This is last Friday where we got an extremely hot jobs report. Interest rates spiked higher. Sunday, we had the action in the Middle East. Had you told me that all this on Thursday, I would told you the S&P would be trading at 3,800. We had a market that had gotten overly bearish. It unwound that position when the market didn't fall off a cliff. All this fuel in here, unwinding that, has been dissipated right through here, and this is called distribution. And you can see right here, we're beginning to get a sell signal, and we're starting to break down. So we have a lot of risk right now, and anything that expands this risk is probably going to induce a lot of volatility across a lot of markets. So if you have grain to market, you're thinking about putting positions on, as my old boss at Citibank, have your head on a swivel and pay attention to everything that's going on. Because right now we are in a situation where we can get opportunities to market our grain a little bit better, but they may not last very long. And that is really everything I have right at the moment. Again, please read the daily commentaries and please listen to the podcasts. It's not because I like to hear the sound of my own voice, it's because I'm genuinely trying to help y'all. So with that, I'd like to turn things over to Elliot, and he is going to talk about band.
All right, good morning, everyone. Yeah, and I'm sure Sterling will challenge me on some things, which is important, so you can hear our dialogue. This is how we kind of challenge things. For growers and agents on the line, I would definitely say, make sure you're aware of our profit matrix tool. This is something that the As an Edge team had developed last year, and it's something that really helps identify the target area for protection, risk management that our growers need. This morning I went ahead and on the left-hand side, I plugged in some values from FarmDoc. This would be more conducive of northern Illinois input costs. So you see a total cost of 860. This does not include land costs because that can be a considerable variable based on the individual grower. And then you can see the matrix showing we're going to use a APH of 200 bushels and we're going to use the RMA projected price estimate of $5. That's kind of close to where we're at. Well, hopefully it'll be higher than that in February after the discovery period. So based on the $5, you can see if you have a loss, if you have a harvested bushel below 75, you're pretty much negative. That's because at 75 level, our coverage per acre is only $750, and we already identified that we have $860 costs plus whatever your land costs would be. So if we want to, with the majority of that profit matrix being red, by maximizing our federal crop insurance, you can see we took away a little bit more of the red away. And you can see we kind of have a floor loss. The revenue protection is going to kick in. So the key again is using, when Dr. Barnaby first created revenue insurance for corn, soybeans, and wheat, his goal was that it was to support growers taking a marketing position. So if we go down to the very bottom, just by us saying we're going to do 10% of our APH, you can see a little bit more of that red went away. So now by taking some type of position in the market, getting that using a 520, so we're gaining 20 cents over that RMA projected price, the grower can leverage his crop insurance to lock in some profitability. Again, with land costs, we're probably quite a bit short, so let's jump this up to 50%. So we're going to use 100 bushels an acre. We're going to go out there and pre-market. And now you can see we're pretty green. We're starting to get into the hundreds of dollars. We have a deeper shallow loss. And then one thing we can do though with our band products is we can further enhance that. So I'm going to go down to my yield band. I'm going to put in a coverage range. So my loss trigger is going to be 95%. I have an 85 MPCI. I'm going to jump the band up to 95, expand the coverage point from 95 down to 80. Combining those two, you can see 150 plus the 850 gives me $1,000 of coverage, which equates to 100% of my guarantee. 200 bushel APH times the $5 RMA projected price. Now you can see the majority of the profit matrix is triple digit. So this is one thing to consider with your risk management is, first, know your input costs. I think that's the most critical thing. And then along with your multi-peril and your band, can you take a more aggressive approach? Let's say let's jump this up to 70. Now you can see all those values went up a lot. Again, I know this is pretty small text. Some of you are just on the phone. So again, work with your agent. Bring in your input costs and just go through some scenarios to see what works best for you. You can also plug in the RMA supplemental county coverages. Again, keep in mind, I think one key thing that Sterling talked about is the cost of money. So there's other products out there. There's an offset between your revenue protection and a private product, but you cannot get paid until June. That's when RMA finalizes the majority of the yields for corn and soybeans for the 3/15 sales closing date. So keep in mind that you may have an individual claim, but cannot be paid by law until the final county yields are expressed. So there is some value to the band products because you get paid immediately at the same time as your MPCI losses. This week alone, I've made over $100,000 of claim payments. My growers in the Southeast, where their harvest price has already been established, we're finalizing those revenue band policies already. Next couple weeks for the 3/15 sales closing date, corn and soybeans, we should start pushing out the revenue band claims as well. So definitely know your input costs, pursue profitability. I think sometimes we have growers get stuck in this rut of trying to outsmart the insurance. The best thing to do is try to outsmart the market. That's where you're going to have your profit. Drive for that profitability. The crop insurance is there to support you so you can make those business decisions with confidence.
Trying to outsmart the market. Oh, Elliot. That is a line.
Yeah,
And as trying to outsmart the market, that's something, I don't want to get into trading psychology and all of things like this, but I've had skin in the game. I bought my first stocks when I was 22 years old. The first time I ever traded a futures contract was with my grandpa when I was 15. So I am a freak of nature. The one thing that I have learned about this, be incremental, meaning look at your total production, divide it up into tranches. That way you can control your risk. It's all about the most important things are controlling risk and optionality, meaning you don't paint yourself in a corner and you always have alternatives. And this is something that if you have a producer who has a question, or if you're a producer on this, I will be happy to sit down and explain this to you, and not in Greek. But the other thing is, the most important thing to remember is you are not going to be perfect. Perfect is not for real. Do not try to be perfect, because that's when bad things will happen. You need to learn, and this is the first thing they taught me at the Board of Trade, check your emotions at the door. Whatever bias you may have, it could be an internal bias. Well, I think, most people are like me. Well, that may or not be. I think this, that, or the other thing. Keep it factual and keep it to math. Everything that goes on in the world, I convert into math, and then I convert it into reasonable outcomes. And that's how you have to do, because if you let emotion take over, that's again when bad things happen, because unless you've been doing this a very, very long time, the natural inclination of people is to sell on the lows, and when markets start moving up, you don't want to sell the high because you think it's going to go higher. Understand your costs. That is the most important thing, because that's one thing that you have control over. The next thing you have control over is your insurance and how you behave relative to the market. And making sure that you know that, hey, this corn at 525, I'm starting to make some money. know that you're going to want to sell 12% there. Okay, at 535, I'm making even more money. Maybe you sell 16% there, but do it incrementally, because if you try and do it all or none, I guarantee you, you're not going to hit things right. And I'd love to tell you that I think corn's, going to be back up and we're going to see $6 sometime soon, unless we have a major weather screw up. And we've had a lot of those the last 5 years. It's going to be a while before we see these prices, get back up to those bountiful, easy levels. One risk that we have, particularly right now, is input costs, especially everything tied to energy, meaning your diesel, fertilizer. Right now, natural gas prices have been relatively tame. Fertilizer prices are probably noticeably better. So if that's something and you see a good price for the fertilizer, again, incrementally start to build a position, because the goal is to have the average be profitable, not necessarily being maximum profit on everything, because that's simply something that, even if you're Goldman Sachs or JP Morgan, that's not going to happen.
Yeah, to what Sterling said, the key is knowing that you have the combination of the federal crop insurance and band can maximize to offset those input costs.
Yeah.
And the insurance should give you the confidence to carry out a disciplined marketing plan. That's really what the band products were designed to do, is how do we support the growers' decision-making process to lock in those, to pursue those profits. And that's really what we want to do with the product. I heavily recommend maximizing the coverage range so you get to that 100% of the APH value, because that gives you more dollars to protect the positions that you need to take once you have those opportunities.
Exactly. And this is something where making money now it's going to be a lot harder. Basis is not necessarily going to be all that friendly, and we may be a while before we see that improve. So we have to look at every detail and look under every rock. And I know it can be time consuming and tedious, but doing that will be, the key to being more profitable. So with that, the stock market that I showed you that was just up a few minutes ago has dropped noticeably. And along with that, corn prices, soybean prices, let's go ahead. And yes, I look and watch this stuff all day and wondering how I haven't lost my mind. Well, my wife thinks I have, so don't worry about that. But here's a chart of soybeans. As you can see, when we were talking, we were just down a little bit. Now, all of a sudden, this chart is taking a decidedly different tone. So frankly, if I had some beans to sell, I probably would be willing to let a little bit of it go, again, in a tranche, because we are north of 13 bucks, which should be a pretty good price. And looking here, crude is being quiet. And our other big worry here, actually, interest rates are back creeping up. And one thing I've noticed, on top of, obviously the Middle East situation, we have the situation in Washington with the Speaker of the House. When these votes were going on, I had this chart up on a interday basis. And actually, I can put it right up here for you here. You see this rise in rates right here? That's all Congress was voting. So this is adding nervousness, and this is changing the playbook a little bit from what we would normally expect and how we would normally deal with things. So once again, most important thing, and I can't reiterate this enough, know your costs, control your costs. So for example, if fertilizer looks cheap right now, where natural gas is, risks are much more tilted to the upside in the energy market than they are to the downside. So certainly look into that. And again, everyone's different. I can only make broad statements about the movements of the markets. But again, if you have individual problems, it's something where I'm, obviously happy to help you understand what's going on. So do we have any questions, Ashley?
We did have one question come in. Can you touch on spreads in corn and beans?
Spreads in corn and beans. Absolutely. Here, let's go ahead and let's push up. Start with corn. That's easy. And go ahead and switch this over. And we're going to go ahead and we're going to look at December, March. And we're going to bring up a chart of this. And well, somebody has a very well-timed question here. We're seeing this chart begin to explode a little bit. And as you can see right now, we're trading about 14 under, which I'm going to go ahead and switch this back to another chart here, and we can go over exactly what this means. See, right now we're at 493.25, and we are seeing a pretty good carry in the market at 1506. So what that's telling me is the market is telling you to go ahead and store grain. Just like in an interest rate market, if the market tells you the best thing to do is buy overnight bills, you buy overnight bills. If the market is telling you to store grain, then obviously if we can find some free money, if this works for you when you're with your elevator, that's what this is telling you, because what will happen, assuming we see a normal Brazilian crop, this is going to narrow and these futures are going to go down. If you have corn in your bin and you have corn to deliver, I would not be hedging it out here with the 493.25 December contract. I would be looking, if you can hang on, if you can move it in March, or better yet, May, you're going to make up a little bit of money on the board. Your basis and your local price probably, I'm willing to wager right now, probably isn't going to change that much, but at least here you can get some free money out of the board. Now, looking at soybeans. Soybeans are a little bit different of a beast. When we start the whole export process and everything going on with soybeans, they move out the door a lot quicker. That's why we see, spreads relative on a percentage basis a little bit tighter. And we'll take a look here at what November, we'll do March. You see the difference here, this minus 38.5. Part of that is the fact that we start getting Brazilian beans coming in. But if we look at the March spread, as you can see, this is deeply inverted again, paying you to store beans, but there is some sign that this may be turning a little bit, as there is some nervousness in, exactly where that Brazilian output is going to be, and the concerns about what we see going on within Argentina. So the maximum spread is probably over, but we're still fairly juicy, but we can expect these most likely to compress going forward, especially as we see, probably most likely some different volatility in the front end of the market.
We had one more question on there. Any insight into Minnesota wheat?
Minnesota wheat, the Cadillac of wheat. Of all the wheat contracts, I am preferable to Minnesota. And that is because, one, we are actually forming a good bottom here. It is also better quality wheat. And that tends to be the market leader. Now, one thing that I'd like to point out here, and let me get back to, well, here, we'll just bring up a chart here real quick of Minneapolis wheat. Here. This is probably one of the most favorable looking charts that we have. Ignore that number, that doesn't update. We're short 23,000 contracts in Minneapolis wheat. And as you can see, this is not only one of the biggest fund short positions in the last 5 years, in fact, the biggest. This is very close, within maybe 1,000 contracts, of being a record short. Okay. Now we're short 23,000 contracts. We have an open interest on the December, which is the largest, of only 41,000 contracts. We have a daily volume so far today of not even 2,000 contracts. So what that tells me is there is the fuel for a potential rally here. And you can, try and take advantage of that as best you can. Normally, if this were cornered beans, I would tell people to go ahead and trade the options. They're liquid, they're easy to do. Minnesota wheat options are a little bit tougher to do, meaning they're not as liquid. They don't perform as well because the bid offer spreads are wide and you're just not going to get that same delta kick out of that. But as an overall market view, this market does have the potential to rally. One, if we see further problems coming into either Europe or into the Ukraine, if we see some degree of shipping problems, a pickup in movement going to the Far East. There's a lot of things that can make this market go up. The fact that the funds are so short, their willingness to pile into that short, they're willing to press the lows, to sell it in the hole is probably a lot less. So if we do get a wake up in the wheat market through some sort of other global thing, this market will have the biggest movement and probably be the most sensitive just to the nature of the way that market particularly trades, the size of the short position versus the size of the market.
All right, that's all the questions that are in the chat.
Well, again, it's the ancient curse, may you live in interesting times. Well, we are certainly upon that. So please, if you have any questions, feel free to reach out. If you're an agent and you have producers who have questions, again, feel free to reach out. If you want to get a group of producers together and do like a virtual meeting, I can do those on very, very quick notice. If you want to do something, if I have some days, 2 hours is enough. 24 hours is always easy. I can certainly make that available, and we can do that customized direct impact for you if that'll help you along. So that being said, I'd like to thank everybody. Our next meeting will be the November WASD, and again, make sure to join us for the November marketing meeting, as we will have the Planalytics folks on with weather, and I'm going to try and see if we can get our fertilizer people to join us as well. And if conditions merit and something happens, we may very well run a special meeting like we did with the Ukraine, again, depending on how things go. So I'd like to thank everybody for their time. Have a good day.